Exactly what I said was going to happen happened. The market started to move down. I showed you what was going on with the divergences, with the seasonality, and how a failed signal is a signal. So now we need to see, what are we going to do now that the market has cracked, as we talked about last week. And I've got a surprise for you. But hey, I'm Courtney Smith. Just want to say hello. Welcome to our weekly video newsletter, TradeSmith. Here, very important that you've got this completely memorized. I suggest that you take all these words and bake a cake using these words. All right, let's take a look at the S&P. So we got the crackdown that we talked about. Remember, well, I don't need to tell you what it was. Okay, but look at a couple of things here. We broke out of a descending triangle formation that we talked about. Look at the purple predictor. It is plunging. It is plunging. What is the objective? How far is this market going to go down? Well, I've got the dotted red arrow, which says we could get down as far as 2030 on this market, which is another few percent. Then no, this is not going to be the big collapse we've been waiting for the last 10 years. No, but we are in the midst of a correction here. The farthest the market's going to go down is 2030 and then start to turn up again. I'll explain as we go through our various indicators, but you can see the whole situation right here. Industrial, same thing, purple predictor, falling out of bed. What does that tell us? The smart money is shorting this market. They're selling. However, the NASDAQ also, obviously, it looks bearish, but it's starting to more interest me again. Let's just put it that way. Okay, now, this was a big thing that I talked about last week. The fact that we had broken down on our seasonality indicator was what was really turning me more bearish. Not big time crash bearish, but bearish, looking for a correction bearish. So what happens is this, is that the market is supposed to rally right now, but it's not. And a failed signal, and in this case it's a failed seasonal signal, is a signal. And it's telling us that the market's going to move lower. Now, I'm still focusing here. We're in the month of November. Probably not going to be the black line down at the bottom because it's failed all year long. We should start seeing seasonal strength come into this market. So far we haven't. That's one reason why I've been bearish. Now let me tell you what happens though. Well, who cares about this chart? Here's what's going to happen. We're going to continue to see the market under pressure until the election. And then I believe that no matter who is elected, we're going to see a rally out of the election. And we're going to start to see the regular seasonality kick into play. And the reason for that is because the market is thinking that it's quite possible. Let me go back to one of these charts here. The market's thinking it's quite possible that Donald Trump is going to be elected, and markets hate uncertainty. The markets pretty well know what they're going to get with Hillary. They don't really know what they're going to get with the Donald. So they're shaking because the polls recently have been much stronger for Trump, showing let's call it a tie. It's give or take. If Hillary is elected, the market will rally because it'll be a sigh of relief, like, oh, thank God, we don't like Hillary. The market's not going to like Hillary, but they're going to say, at least we know what we're going to get, so now we can deal with it. If Trump gets elected, the market's still going to rally because they're going to say, oh, we've already discounted the bad news of him getting elected, so now that he's elected, we'll rally on the good news. That's the way the market's going to be thinking. Now, maybe if Trump's elected, we'll go down maybe one day, but basically we should see the seasonal bullishness kick in after the election. We're discounting right now all the possible bad news of the election. And so when the election actually comes, there'll be a sigh of relief, or we're selling the rumor, buying the fact right now. So that's what's going to probably happen here. So we're setting up for some good buy spots. Yield curve's not telling us a lot. Asset allocation shows that money's flowing into the stock market rather than the bond market, which is pretty crazy, but there you go. Our stock market RISKDICATOR started to bounce up a little bit, also bullish for stocks a little bit. Global shares gapped down on Friday, so that's looking pretty bad. Don't want to be there, as I said last week. Japanese shares is where I want to be, but I want to be in DXJ, not in EWJ. And there, we're rocking and rolling, making some good money there. Treasury notes. You know, I've been obsessing about bondage recently. Well, let's take a look here. The market gapped down, and I told you I've been pretty bearish on the bond market. The market gapped down a little over a week and a half ago, and so far what we've done is fill the gap. Now, what's going to happen this week is very important. What we should see is the market start to sell off. We should start to see us start to go down to maybe 130, 129 on the bonds. But here's the thing. We need to be alert to the possibility that we could start to see a rally. I'm still calling for a lower prices, but if we break above that, if we settle above 132, that's going to trigger some buying coming into the bond market, lower interest rates, and that's going to shake many, many markets, including the stock market, the dollar, gold. So watch it very closely. We could see something like this occur. This is a potential scenario, so we need to be alert to it. We break above 132, we have the election, interest rates start to go down, in other words, bonds go up, the market then rallies, dollar goes down, gold goes up. Now, that's a potential scenario. Now, here's the cool thing is, because we have that scenario, we can put in orders right now to capitalize on that price movement. Bond key factors, still not much. I mean, it's just a mess. The most important factor, though, is the blue line. The green line is the 10-year Treasury yield. The blue line is the yield in Germany. And I think right now, the competition with the German T-notes is the most important factor in this market. That's going higher interest rates. So I'm generally still on the side that the bonds are going lower, interest rates are going higher. But what's happened is that has caused a shakeout in the dollar. Now, last week, I told you about the objective that I had for the dollar. We got there and we're selling off. Everything is going according to plan. But what's going to happen now is we're going to get down to about 96.25, 96.50, and the dollar is going to turn around and start going back up again. So we're just in a normal correction in a bull market, a weak bull market. But that means then that gold, which has been rallying because, of course, the dollar is going down, so they're mirror opposite of each other, it got back up to the breakout level where we were able to make some good money shorting gold before when it broke out of this triangle formation. We're back up to the breakout level now. It's going to be hard for gold to move any higher, particularly if we start to see the dollar stabilize. But since the dollar is going to continue to lower over the next week or so, I think we're going to probably see this bump up maybe to 1320 to 1330. We'll keep an eye. Gold short-term indicators. Up at the top, that's the yen. That's bullish for gold. The middle panel is the CRB. That's bearish for gold. And at the bottom is the yen. The top is the euro. This is the yen. It's bullish. And so 2 out of 3 of our indicators are bullish for gold right now. Oil, perfect prediction here. I told you it would get up to the old highs. It did. We talked about this last week. It's heading lower. I think we're going to get down to about $40. Right now, there's just the demand is weakening for oil. We're starting to see some increases in production after seeing decreases. We're starting to see companies start to talk about expanding capital expenditures, whereas they'd been slashing them dramatically. Now they're talking. They're not really expending any more money, but they're starting to talk about it, and that's weighed on the oil market. Nonetheless, we're not going back down to $28 on oil. I'm not worried about that at all. OPEC never agrees on anything. They agreed on something and they're not keeping their word again. Nothing new here. So let's just call it down to maybe $40 and then we should bounce. This is going to be in a big trading range for a long time. Hey, thanks for being here. Thanks for inviting me into your home. It's been fantastic. I won't bother giving you the pitch. You can read it. You hear it every week. What the heck, huh? All right. Listen, freebies, love having you here. Hope you can go out and take this information and turn it into actions that will make you money. If you can't, then you should subscribe. Let's be real. All right, fully paid up members, hang on just a second. Got some interesting stuff that I want to show you to expand on what we're already talking about.